So question number 3 here is an issue that you really have to ensure that as you are saying you are fine, you are really fine, right? So you have to be careful with that. Not just the formula as you see, then you just pick it up that you are fine, but you really have to cement your understanding and ensure that you are really fine. As you have indicated, you are fine. Then, apart from question number 3, I think that the rest are fine. The rest are fine, with the exception of the theories. The theories are questions when it comes up, it is not easy to do it. It's not easy to do it, right? It's all the time complicated. So you have to ensure that the theories you also have to tax. But basically, the most important bit which might get students confused, and I will still want students to look at it, is the example 3 here. The example 3 here, right? So if you are okay, then I can conclude by saying that we can now use absorption costing and activity-based costing in determine the valuation of what overhead. In determine the valuation of overhead. In determine the valuation of what overhead. That's okay. So we can use absorption costing and activity-based costing in the valuation of overheads. In the valuation of overhead. Now, I move on to the next type of question. That is the next type of area, that is topic, right? That is transfer pricing. In the case of the topics that I share with you, the next bit is what? Transfer pricing, right? So I'll move quickly also with the transfer pricing, the transfer target costing, sorry. I just wrapping up with some bits, so I just wrapped up with some bits, so I'm a little bit not stable, but I think that I'm fine now. Target costing is the next type of topic. I indicated that we start with the all costing techniques, and the first costing technique we looked at MC, ABC. We do not look at marginal costing. It's not tested. The examiner, PM examiner, did not look at it, right? So we have one MC, we have what? AC, and we have what? ABC, and we have ABC, ABC, right? What is tested over here is absorption costing and activity-based costing. These are the two which are testable, and that we have to really go through that again. So we move on to the next one, which is target costing. Target costing, also a costing technique, but the assumption is different from those bits we've looked at. Then we come to the next, environmental costing. Environmental costing. Your examiner has indicated clearly that environmental costing, your examiner has indicated clearly that students are to only learn the theoretical aspect of environmental costing. There wouldn't be any calculation on environmental costing. It is actually specified, and we have talked about in the examining PM examining team over and over again. God willing, by Monday, we should receive the scripts. In the case of those students who sat for the Wednesday paper, the scripts should be sent to us. That is what exactly happens. Students tend to write it on Wednesday, then we receive the script on what? Monday. Not like the previous setting where it was a paper base. A paper base, ACCA needs to use just 5 days to scan the paper, and then after scanning the paper, they have to ensure that after scanning it is really in order. Then they will now contact us. Then they just forward it to us in that perspective. In fact, during those times when it was a paper base, I was not a marker. I wasn't a marker. So I cannot talk much about it, but the only thing is that I knew one of our tutors who was marking, and that sort of issues he tends to tell us in that base, right? But as it is in our current situation as a computer-based exams, I happen to be an examiner in that regard, marking students' exams in that bit, right? And what I will tell you is that we need to really move quick in the case of the knowledge base. Then we need to really practice using the computer-based format, right? There are some few skills that we can just get in there, right? The PQ Maxim has actually talked about how some students actually suffered in the case of using the computer-based perspective in writing the exams. And those students, when they were interviewed, they were not practicing using the Excel in writing their answers or in solving past questions whilst they are home. They were just using the paper and pen. In fact, they actually like the paper and pen that bit. Knowing for sure that your exam is no more going to be paper and pen, but they still use paper and pen in writing and solving past questions, right? So we need to desist from that attitude. Everything should be in Excel. Every computation, the Excel sheet should be what your notebook, that sort of, right? Good. So the environmental costing topic, it has been indicated in your exams perspective, right? Kaplan test talk about it. BPTP test talk about it. Open tuition, that old man talks about it. The PM examining team, right? We individuals who are marking the paper, we are telling you that you are never going to be tested in calculation in the case of environmental costing. So why should the students still sit down and just say that, walk me through calculation? I will not do that, right? Because it is not an area that we are going to look at as a basis of testing. So why do I have to waste my time? I need to focus on the important areas, right? So that is what you have to note, and you can just just go through that bit. We have one of our colleagues. We have one of our colleagues who attend to interact more. You can just have him as a friend. He's already on LinkedIn. You can have him as a friend. Just have a chat with him. In the case of PM, performance management bit, he's in the case of what? Steve Willis. He's the case of what? Steve Willis. So those of you who are already on LinkedIn, you can just search for my colleague, Steve Willis. You can just let him know that Henry is your PM tutor. You can just interact with him. Anything that you want to ask him, you can ask him that bit. That is okay, right? So in our circle, we still tell you what you should know, and you have to listen to that. You need not to be recalcitrant. You have to listen to that and just go by that exactly, right? So environmental costing, then we are looking at life cycle costing. Calculation theory. You look at the two, and not like environmental costing where we are only examining what the theoretical perspective. In the life cycle costing, calculation and theory, we are looking at both calculation and theory, right? So if we're able to go through this bit, then that ends it in the case of what? All the costing techniques. So far as we have walked ourselves through the first bit, which is the case of absorption costing, activity-based. I'm not talking about marginal costing because it is not examined by the PM examiner. So we are not looking at it. That's why I'm not even mentioning it. So far we have gone to absorption costing, activity-based costing, and I explained that all these two topics came because of the discrepancies in the valuation of what overheads. It only helps us determine one valuation of cost, not the entire cost of a product, but a section of the cost of a product, which is overhead valuation. We move on to target costing. Now, before I will really look at the document and actually apply everything based on the document, I need to really explain for students to understand what we mean by target costing. Right, with target costing, it is a modern costing technique where we actually look at incorporating the views of what customers. We look at incorporating the views of customers. Instead of just being at your scoreboard, your warehouse, or your production site, produce the product, you do not ask the customer as to whatever he needs, their requirements and those bits. You tend to produce the product and you bring the product on board. Target costing do not look at that. Those sort of setting where you do not seek the views of customers, it's highly possible that there's going to be a lot of waste. It is highly possible that there's going to be a lot of surplus, that your demand will never be equal to what your supply. Right. So target costing perspective, the way of determining the cost of a product, this is a process of determining cost of a product. And the way we determine the cost of a product is first of all by looking at what you call external analysis, where we tend to go to the market, listen to the views of customers as to how they want the product to be in the case of their requirement, that sort of. Then, based on the fact that target costing operates in a perfect competitive market, where information is available to every producer, buyer, or seller. So we tend to just get their views as to the element of cost. Then thereafter, we tend to come to the scoreboard. You move from the external point of view and you come to the internal point of view that is in your company, and you look at how you can benchmark what you heard from the external view into real production, into real production. So this type of technique look at quality management. So students who have gone through total quality management have learned TQM, that sort of issue is what we are looking at over here. Target costing. We do not apply target costing to the overall market. Let's say if we tend to have the entire world as a market of your product, we do not look at it in that broader perspective. You have to select a niche. So we select a niche. A niche is going to be a section of a segment. So we can come out with 4 main segments. We can come out with 4 main segments. And in the 4 main segments, we can pick one of the sections of the segment or one segment, and that would be our niche, right? So what example can I also give over here? We tend to have a lot of universities in Accra. I can just pick, let's say UPSC, and UPSC becomes my niche, where I'm going to study the students of UPSC. In the case of undergraduate, diploma, master students, I tend to study them, know what they prefer, then actually go by that. This is the point where, forgive me to still say this, I tend to talk about it all the time. I actually do not look at what Baron Distilleries tends to come out with, right? Baron, sometime back in the case of 2013, 2014 perspective, introduced his pure water, that sort of pure water, which was more of condom-like nature, right? Which was more of condom-like nature. And I quite remember those students at UPSA were very happy. The ladies were very, very happy looking at their texture, because at that point in time, that was the only sort of water with that sort of water texture, right? And they actually liked it. I remember the one point at Prestige Hostel, those ladies were just trooping, descending to buy that. So I just wonder, why didn't Baron decided to capitalize on that perspective by only selecting university students, in the case of the ladies, as what his niche, selling to them. But probably maybe he wanted to look at the broader perspective, decided not to look at just students, ladies. Maybe he, according to his analysis and research and his conclusions, he thinks that that will not be enough to give him the revenue that he needed, right? But on other context, he can produce that type to suit the students and produce the current type to suit the other public, to have a broader perspective in the case of his customer base, right? But we cannot critique that. We are not Baron, and we cannot really think and decide for him, right? That perspective, right? So here with target costing, we tend to look at external analysis, tend to sort their views, tend to listen to them, just make our analysis. Then we come to the scoreboard, that is our in-house, to now put in effect whatever we heard from the external focus, right? From the external. So this is what actually differentiates the first costing technique, that is absorption costing, activity-based costing technique, from target costing, right? So I proceed. An important reason for calculating the cost of the product or service in the order to decide on a selling price is what we are looking at as the main important bit. We want to determine the cost, and after determining the cost of the product, we can determine the selling price. Because after determining the cost of the product, we cannot factor in either a markup or a margin. They are all elements of profit. A profit can be in the form of a markup, or it can be in the form of a margin. Then thereafter, we can estimate our selling price. So we have looked at traditional techniques like absorption cost, activity-based costing, but we are looking at the modern approach, which is called target costing. So what are the steps in dealing with target costing? What are the steps in dealing with target costing? So we look at steps in target costing. These things are to be learned practically. We are not supposed to look at it in a theoretical perspective. Thereafter, after the recorded lecture, you sit down and try to pretend that we are a management accountant of a company. How will you put into effect target costing? So you have to make it more practical by thinking through, by brainstorming. You don't just look at it when we say step 1 is that, step 2 is that bit. No, it will not make us a very good student. At the end of the day, wherever we tend to work, we should have that sort of skill. If you are an auditor, wherever you can probably just get opportunity to audit Unilever or any of these manufacturing organizations, and you still need this bit to bring these ideas into bear, right? Good. So step 1, we are going to look at external analysis. That's the first stage, right? So what we tend to do is that from research of the markets, as you tend to go to the markets through surveys and that bit, determine the selling price at which the company expects to achieve the desired market share or what target selling price. Do not forget that we are not operating in a monopoly market where there can be price discrimination, right? Here, information is available to what customers, producers, buyers, and sellers. We all have that bit, so you cannot tell, you cannot actually deceive me. And so they can just say, oh, what if we're getting this information from customers? What if the actual value of the item is 10 Ghana cedi, and they tend to say that all the customers say that is 2 cedis? It will never happen that, because it's a perfect competitive market where information is available to everybody. You can't deceive me, my friend. You can't deceive me, right? So from research of the market, determine a selling price. So there's going to be a selling price, right? There's going to be a selling price. And out of this selling price, we have to determine the portion of this selling price. So just a moment, let me use this to keep myself in good shape, right? So based on the selling price, right, I'm going to determine a portion of this selling price, which is going to be a cost price, and a portion of this, which is going to be what? Profit, right? So this is the sort of issue that we are basically looking at, right? So I'm back to track. So here is going to be the profit element, and the other side is going to be the cost price element. From the market survey, you are not looking at selling, because at the moment you have not gotten to the point of even having your product ready to sell. You need to get the selling price from the market, and you use that one to determine the cost price. The cost price is what you are looking at. So this cost price here that you tend to get from the selling price information they give you, and the profit element, you take that out, you get the cost price. And that cost price is what we call the target cost. We call it the target cost. And target cost is also called desired cost. Target cost is also called desired cost. This is how much the external focus, those customers out there, this is how much they desire the cost to be. This is how we want the cost to be. This is how we desire the cost to be. So a target cost is also called a desired cost. We know for sure that in calculating cost price is selling price minus what? Profit. Cost price is selling price minus profit. So if you have the selling price from the market, then they give you a portion either at markup or margin. You can take that bit from the selling price, and at the end of the day, you get what? Your profit. At the end of the day, you take the profit out. At the end of the day, you get your cost price. The cost price, that is the cost of the product which you have gotten from the market, which is from the customers through external analysis, is what we call the target cost, also called the desired cost. So step 1 says, from research of the market, determine a selling price at which the company expects to achieve the desired market share. That is the target selling price. So after getting the selling price, so step 1 says that you just have to get the selling price from the markets. Then step 2 says, after you have gotten the selling price from the market, there's going to be a portion of profit which you need to take out from the selling price to get the target cost. So step number 2 says, determine the profit required. Example, a required profit margin, or it can be a markup, or the profit can be tied up to return on investment. A return means a profit, and we can estimate return on investment. Later on, when we tend to look at divisional performance measurement, we will still come back to return on investment, which is shortcut given the just the acronym ROI, return on investment. A return is a form of profit. So thereafter, we can estimate our target cost. We can estimate our target cost as the target selling price minus the target profit. And I've indicated that a target cost is also called a desired cost. A target cost is also called what? A desired cost. Target cost is also called a desired cost. Then we come to step number 3. Step number 3 says we calculate the maximum cost per unit. Now that it can be that the target selling price they give you is huge, let's say $350,000, and the target profit you got it to be, let's say, 20,000. But we can ask you to calculate the target cost per unit. We can ask you to calculate the target cost per unit. So if such a situation arises, So we can say the target cost, forgive me, let me just make it TC. If the target selling price was 5 million, right? And the target selling, the target profit was 1.5 million. At the end of the day, we get a target cost of 3.5 million. But this 3.5 million, huge value, the examiner can ask you to calculate the target cost, so TC per unit. TC per unit. So if we are asked to calculate the target cost per unit, the target cost divided by the unit. The word per means divided. So target cost per unit means target cost divided by the number of units. So here I have it to be 3.5 million. Then I'll divide it by the number of units. Let's say you have 200,000, or let's just say 2,000 units. So I'll say times 2,000 units. So at the end of the day, if I divide 3.5 million, this is going to be monetary terms. If I divide this $3.5 million divided by 2,000 units, at the end of the day, the answer I get will be the target cost per unit. Target cost per unit. So the standard analysis, step 1 to step 3, has showed us how to estimate the target cost. How to estimate the target cost. Then we come to step 4 to step number 6, which is internal analysis. Now that you have gotten those views from the market, you now come to your scoreboard, your in-house, and try to produce based on what you have heard. Based on what you have heard. Because that is what the customers desire it to be. And we are in a perfect competitive market where all sellers are price takers. So in a perfect competitive market, let me indicate that in a perfect competitive market, all sellers are price takers. Nobody's a price setter. Nobody's a price maker over there. So in a perfect competitive market, all sellers are price takers and cannot impact the price. So you have to take the price as it is. That is why we say they are all price takers. It is not like a monopoly market where they are price makers. So let me just indicate that here. So monopoly markets, right? Monopoly. So monopoly, they are price setters. They set the price. You cannot tell them what to do. They actually state exactly what they want to do, right? It's just like sitting in a car, a trust key, and moving from wherever you were to the house. You cannot force the driver to fly. Right? You just have to exercise patience. When the time is due, you actually alight, right? And in life, a lot of things can happen. You cannot all the time pretend that there's that sort of stethoscope. If it's 8 all the time, 8, something else can happen. So as a human being, that's why we create budgets, that sort of issue. So you have price setters, also what called price makers. These individuals tend to state whatever they want to sell the price. They need not to actually seek the views of customers. What is the sense of seeking? They don't need to seek the views of customers because they actually are monopoly. And monopoly actually decide on whatever they want to do. ECG can decide to off light today and there's nothing you can do, right? There's nothing you can do. You can't just go there and go and slap anybody to actually on the light, that sort of. So monopoly, price setters or price makers. In a perfect competitive market, which target costing is applicable, we tend to be sellers who are price takers, right? So after hearing all those bits from the customer's external perspective, you now come in-house to produce it. So step 4 says compute the expected cost by considering this bit. So you've heard those things from the customers, you now come in-house and get those things done. So if you know for sure you need to incur material cost, what is the material cost? So material cost, that bit, you pick it up. Then labor costs. So labor cost, how do you calculate labor cost? Labor cost all the time, hours worked by labor times rate per hour. That bit. In the case of the material, we can give you in the case of kilograms. So I can just say number of kgs times price per kg. Number of kgs times price per kg, right? Good. Then later on, we will look at waste, the impact of waste. Later we can look at the impact of waste. But let me just give an example over here to incorporate what I want to estimate, right? Let's just say that you want to estimate what you want to calculate your expected cost. Your expected cost. Okay, so calculate the expected cost. Calculate the expected cost. If material cost is $5, I'm just creating this from my head, $5, and it takes, oh, am I writing caps? And it takes labor 30 minutes to produce the products, giving $25 per hour and 10% idle time, and 10% idle time. So let's say that overhead costs, I want to take you straight to the example. That is why I'm bringing this example. Let's say overhead cost is what? Let's just say $15. So how do you calculate the expected cost? Let me use a different color to do that calculation, right? So in going through this bit, we said that the expected cost is calculated by estimating the direct material cost, the direct labor cost, and the overhead cost, as you can see clearly here, and estimating the overhead cost. The overhead cost, we can use either activity-based costing or absorption costing in estimating the overhead cost. So far as you all have indicated that you are fine, I will not come back to talk about this bit. I'll not come back to talk about this bit. But you use the issues of activity-based cost, absorption cost to determine the overhead cost. So let me proceed. Harry, proceed. So how do you estimate the direct material cost? So in this regard, I can say that my direct material costs, right? Let me just use this part because that's side I finished with that. So I can say the direct material costs. The direct material cost has already been given to me. Let me just indicate dollars here. The direct material cost has already been given to me. What was the value? 5.20. So per unit. So there's no need for me to do any calculation. So $5.2. And what is the direct labor cost? This side you have to be very careful. Direct labor cost. Direct labor cost. How do you estimate the direct labor cost? The direct labor cost is calculated by looking at the number of hours worked by labor times the rate per hour. That is how to calculate. Unless otherwise there's an idle time or there's waste, then you need to flex that. We need to flex that. I'll show you how to do the flexing. So they are saying that this time around, labor is being paid $25 per hour. But the labor work for an hour, labor work for only 30 minutes. So we need to convert this, and the rate is per hour. So we do not have rates in what? A minute. So what I have to do is that I'll convert this 30 minutes in an hour, then I'll multiply by the rate per hour. But because there's 10% idle time, I need to flex that. So what I'm going to do is that, so we have labor working for 30 minutes. So I'll convert minutes to hours. And I think by now you should know how to convert minutes to hours. So I'll say 60 minutes is equal to 1 hour, therefore 30 minutes equals what? So I'll just say that if 60 minutes, sorry for doing this, but I have to do presume that somebody do not know this bit so that this I can go through, right? So if 60 minutes is equal to 1 hour, then the 30 minutes will give us how many hours? So at the end of the day, I just put a question mark here. So it is going to be 30 minutes, right? 30 minutes divided by 60 minutes, that bit. So that is exactly what we are looking at. So divided by 60 minutes. So I just say 60 minutes, then times 1 hour, At the end of the day, what answer am I getting? I'm going to get 0.5 hours, 0.5 hours. So the time available here is 0.5 hours. So I picked up that 0.5 hours times what is their rate? How much are we paying them? In the question, we've indicated that we are paying labor $25 per hour. So I multiply this by $25. What answer am I getting? I end up getting what? 12.5. 12.5. So you can see that chunk of the cost over here is coming by labor. Labor is charging us too much. Is it that this labor is skilled that we can use unskilled labor to also do that same job? Right? Because you can see clearly that labor is really costing so much. Overhead is also costing so much. What type of overhead valuation are you using? Is it activity-based costing or absorption costing, which is creating this huge cost? So overhead per the question is also 15. Let me just say overhead is even the huge cost over here. So by adding up all this bit, 15 plus 12.5 plus 5.2, what answer? 17.7, 17.7, so 32.7. So overall, we end up getting 32.7 as the cost of the product, So I'm imagining that after listening to the customers out there and coming to the scoreboard, the in-house company to produce the product.
Idle time, please?
It is costing me, the idle time, I didn't adjust it. Thank you very much. I didn't adjust the idle time, right? So let me just adjust the idle time. That is a very good sort of. So let me just see. It's actually causing the problem over here. So the idle time, because we have 10% idle time, in flexing it, we make it what? Actually change the position, but do not worry. I'll just keep myself satisfied. Let me just shift this to that point. Right. So because I want to deal with this bit, what I'm going to do is that. So I'm just going to make it that bit. So 0.5 hours, 0.5 hours times the dollars here. We have what? $25. And adjusting it, flexing it in the case of idle time, I'll just say 100 over what? 90. Now, this idle time is going to make the workers spend more hours, and the more hours will create extra cost. If you make it 90 over 100, you are rather reducing cost. That means we're trying to say that if customers actually tell you that they use 300 hours, meanwhile, 200 was really, they actually used 200 to play music. You're trying to say that the idle time, the extra hours they spend is rather going to reduce your cost. It doesn't happen like that. So far as you pay labor based on the number of hours, if they are creating waste by not doing anything, in the case of idle time, it increases your cost. So to increase the cost, we make it 100 over 90. If you make it 90 over 100, you're rather saying that idle time will reduce cost. So basically, this is how to flex. The labor cost. So 100 over 90. So that 12.9 we got should be affected, right? So let me just multiply that 100 over 90. 100 over 90. Let me just do that. You can also do that wherever you are to also assist. So I have 100 divided by 90 times 12.5. I have 12.5. So I'm getting 13.88, right? So that means the labor costs, the total cost of the product. So let me just say expected costs. So please do not use the 12.5, but it's a 13.8. So the expected cost is going to be the direct material cost, which we have it to be 5.20 plus the direct labor cost after flexing. We have $13.88 plus the last bit also in dollars. We have it to be 15. So at the end of the day, what answer are we getting? So we get 33.88 plus 5.2. So a moment. So 33.888, right? Plus 5.2. That gives me 39.39. So dollars, 39.088. That is the answer. If I've got a different answer, please just come clear and let's get the right thing done and move away. I'm calculating that I can get it wrong over here. So you just have to also do a recalculation over there. If it's fine, we proceed. So far, This is how to account for what? Idle time. It can also, this same bit could have also been in the case of what? Materials. It can also be in the case of materials. So we have indicated that to calculate the material cost, we need the number of kgs or the number of units. If it is kgs, we need the number of kgs we bought times the price per kg. If it is in units, we need the number of units we bought and the price per unit. That way. But there can be an instance where there's going to be issues of what? Waste. And if there's 20% waste in materials, let's say 2%. This time, let me just say 2% waste. You make it 100 over 98. 100. If it's 3% waste, 100 over 97. 4% waste, 100 over 96. 10% waste, 100 over 90. What about 12% waste? 100 over 88. I think you have picked up the skill already, right? I think you have picked up the skill. So the idle time, it can be idle time. The way we flex labor cost in the case of idle time is the same way we flex material cost if there is one element of waste, because the target costing system actually eliminates what? Waste. All inefficiencies, we look at eliminating inefficiency. Waste increases cost and it will make the cost very huge. So you have to eliminate waste. Now, there's an important statement over here. In your quest to calculating overhead cost, we are saying that overhead cost, do not be surprised that you want to calculate overhead cost in the case of target costing. The examiner wants you to apply the bit of activity-based costing and absorption costing. Do not be surprised. That is why we have gone through activity-based costing and absorption costing. Now, in the case of labor cost, there's a topic that we have to look at, which is called learning curve. The examiner will tease your mind in applying learning curve to estimate the number of hours worked by labor. So if it is not that perspective, then all the time to calculate labor cost, it is the hours worked by labor times the rate per hour. If there exists idle time, you flex it. But sometimes the hours worked by labor will not be given to you on the day of exams. Sometimes the hours worked by labor will not be given to you on the day of exam, and you need to use the theory of learning curve to estimate the number of hours worked by labor. At this point in time, we have not gone through that bit. We will go through, right? So I'll state, note that the examiner may call for the use of learning curve theory to estimate the hours worked by labor. This topic will be treated later, right? You look at this. You look at this. I'll be in a haste to look at that topic. Right? So that at least it will really make us 100% in the case of all the areas and the tricks that the examiner can actually expose us to. Very, very important. Very, very important. So note that the examiner may call for the use of learning curve theory to estimate the number of hours. If the number of hours is not in the question, you need to use the theories of learning curve to estimate the number. So look at all the bits and pieces that the examiner can tease your mind in making you uncomfortable. But be ready to get those bits done, and let's proceed. As I tend to move, please, if you have any question or questions, you can unmute your speaker and come clear with that. Right. So I proceed with the next bit. So that is step 5. Compare the estimated actual cost with the expected cost or the target cost. So what are we trying to see over here? You went to the markets. Customers said that to them, the price of the product is supposed to be $30. When you came to the scoreboard, after producing it, making it practical, bringing it into reality, right? Moving it from the dreams land to the physical world, it actually happened that you got the product value to be 35. There is a problem. Customers are saying that they want the product to cost $30. Now you are saying that for you after production, you think that the product is going to be 35, the cost. Now what happened over here is that you have to find ways of eliminating the 5. Because you cannot influence what the market. We are in a proper competitive market. You cannot tell us what to do. If all buyers, the numerous customers, the numerous buyers, the numerous sellers, let me just talk about sellers. If all the sellers are saying that they are selling theirs at 30, and you are saying yours is 35, forget that we are not going to buy your product. You are not the other profit element to it, and the figure is 35. Don't forget that you are not the only person in the market. That is why you are not a monopoly. A monopoly can even say that for me, I don't care, it's still 35. And people still buy that. But a perfect competitive market, you can't tell us what to do. So the customers and the market are saying it's 30. You came and you are saying it's 35. If you are not able to eliminate this 5, do not produce the product. If you become recalcitrant to still produce the product, there wouldn't be any demand for your products. Maybe you want to just waste your money. That is fine. You can do that. So that difference between the expected cost, actual cost by producing the product, compared with how much the customers, the market want it to be, we call it what? A target cost gap. And you have to find all ways to eliminate the target cost gap. If it cannot be eliminated, do not produce the product. So first of all, target cost gap. Target cost gap. Target cost gap can be estimated if we have what? The target. Let me just say the expected cost. Then put it to brackets, e-house minus the target cost. Minus the target cost, which is also called what? So let me just make it hyphen, desired cost. Desired cost. And that is coming from the external analysis. External what? Analysis. External analysis. Good. So if the expected cost becomes greater, right? Let's just say that the expected cost, just like the example, the expected cost is what? 35. 35. And the target cost from the market is saying it is 30. You need to eliminate the 5. So there's a target cost gap of $5. Somebody will say that, but Henry, $5 is nothing. If it depends on the number of products you're producing. If you're producing 1 billion units, you will not tell us if the $5 is nothing. So far as there's a target cost gap, you have to find ways of eliminating the target cost gap. If the product cannot be eliminated, the target cost gap cannot be eliminated, do not produce the product. So decision rule. I'll end with the decision rule. Produce the product if A, there is no target cost gap. B, if target cost gap exists but can be eliminated. So the decision criteria to decide whether to produce a product or not to produce a product is what I've shared with you. We only produce a product, so that's the decision rule, the decision criteria. Produce the product, if there is that product in question do not have any target cost gap. Or probably there exists a target cost gap, just like in this case of $5, but you can eliminate the target cost gap. Fine, produce. Do not produce the product over here if there exists a target cost gap and you cannot eliminate the target cost gap. So this turns out to be a decision criteria. It tells the producer whether to produce or not to produce. Produce or not to produce is based on the fact of the target cost gap. If you can eliminate it. If you cannot eliminate, do not produce it. Right. So we have some examples in here which I would want to walk you through. We have some examples in here which I would want to walk you through. Right. So question number 1, example 1, it is entitled what? Example number 1. It is entitled example number 1. Right. So Packard PLC are considering, Packard PLC are considering whether or not to launch a new product. So they are in a dilemma, they are in perplexity as to whether to launch a new product. The sales department have determined that the realistic selling price will be $20 per unit. So the sales department, based on survey from the market, they think that, and based on what the customers have said, they think that $20 is enough. Packard have a requirement that all products generate a gross profit of 40% of selling price. Calculate the target cost. We have already indicated that in calculating target cost, we need what? The selling price. We take an element of profit out of it. Right. So over here, what is the selling price? The selling price is what? $20 per unit. Over here, the selling price is $20 per unit. Over here, the selling price is $20 per unit. That is okay. Then the target return, the return as I indicated is a profit. So the profit is what? 40% of the selling price. Of means times. So 40% of that, what answer are we getting? So we say the profit here is 40%. So 40% off the selling price. What is the selling price? The selling price is $20. At the end of the day, what answer are we getting? We end up getting what? $80. So we know for sure that cost price is equal to selling price minus profit. So here we can say that the target cost is equal to the expected selling price, the expected selling price minus the expected profit. So we have those bits and pieces. We are in good shape. So I'll just say $20 minus my $8. And finally, the answer I'm going to get is going to be $12 per unit. Right. So this ends it in the case of the first question. Calculate the target cost in that regard. But here, because they gave us the figures in per unit, at the end of the day, the target cost will be in per unit. If it were to be total, like 2 million, 3 million, those bits, we need to convert it by slashing it by the number of units to get it per unit. I move on to example number 2. Example number 2. Hillet PLC is about to launch a new product on which it requires a pre-tax ROI of 30% per annum. Buildings and equipment needed for production will cost $5 million. So building and equipment will cost $5 million dollars. Let's move on. The expected sales are 40,000 units. Expected sales are 40,000 units per annum at a selling price of $67.50 per unit. Calculate the target cost. Now, this is where we are using ROI, return on investment. And ROI, return means what? Profit. So I estimate my ROI. The return here is 30%. It is on the investment. The investment here is the 5 million. So the investment was in equipment, building and equipment, which is an asset. We can invest into an asset, right? So the investment was in assets, so 30% times 5 million. And 30% times 5 million will give us 1.5 million. This is a huge value, right? So that is the profits. And we need to estimate. So now that we have the profits, so let me just see the profits. So this is the profits. But what is the selling price? I don't know the selling price. But because the examiner gave me the selling price per unit and he gave me the total number of units, so I can estimate the selling price. So you just say the expected, though the solution is in there, but I still write that. Expected revenue is the number of units we are selling. You can only make revenue on the quantity you have sold. So we are selling 40,000 units. 40,000 units. And what is the price per unit? The price per unit is $67.50. $67.50. At the end of the day, that gives us 2.7 million, right? So now that I have my selling price and I have my profit, I'm in good shape to estimate the target cost. Hence, the target cost is going to be the expected revenue. So my expected revenue minus the profits, which came by what? ROI. So that bit, I have the expected revenue to be 2.7 million. So 2.7 million minus the next bit, which is what? The profits. The profits, we got it to 1.5 million. So technically, you get your target cost. You get your target cost of 1.2 million. But if the examiner wants to estimate the target cost in huge value like that, that is okay. But sometimes he can tease your mind in computing the target cost per unit. And so far as I have the target cost, let's just assume that we have been triggered to estimate the target cost per unit. Right? So if I want to estimate the target cost per unit, I need the target cost, I need to divide by the number of units. So over here, it would have been what? 1.2 million divided by the number of units. What is the number of units here? It's 40,000 units. 40,000 units. So what answer are we getting? We end up getting what? $30. If it is in pound, 30 pound, either of them, right? Doesn't matter, right? So we have what? $30 per unit. Per unit, right? So that answers for question number 2. Then we come to the most important bit in the case of profit, which the examiner can tease your mind. I indicated earlier on per my submission that the profit can be in the case of what? Markup or margin. So let me just sort out that bit before we proceed. Dealing with the confusion of markup and margin. Dealing with the confusion of what? Markup and margin. So I first of all start with markup. So I've decided to give an example, then use the example to cement your understanding in that regard. The selling price of a product is $10 and the markup is 22%. What is the cost price of the product? This turns out to be basic business mathematics, but I tell you, it turns out to be a wake-up call for every student, right? Anytime we talk about markup, you should note the conditions at hand. Anytime we talk about markup, that means cost price is 100%. So with markup, cost price is 100%. Right. So if with markup, cost price is 100%, we should recall that selling price is cost price plus profit. So if in this example, the examiner is saying that the markup is 22%, then that means the profit element is 22%. And because we know for sure that cost price is 100%, then we can bring in, because we are talking about markup, cost price is 100%, then we will have the selling price, to be 122%. We will have the selling price to be 122%. We have the selling price to be 122%. That is it. You have the selling price to be 122%. Because in markup, anytime we talk about markup, cost price is 100%. So if cost price is 100%, I already have cost price to be 100%. That is determined because you are talking about markup, cost price is exactly 100%. And you are telling me that your markup percentage is 22%. So thereafter, I can say that your selling price percentage is 122%. So if I know for sure that the selling price was given to me as $10, then I can say that if $10 is equal to 122%, then the cost price they are asking me to find, which 8% is 100%, will give me what value? So that will give me what value? So what I'm going to do is that, I'll estimate the cost price by just saying that 100 divided by 122 times $10. So if you go through that analysis, you end up getting the answer to be $8.2 dollars. You end up getting to $8.2. So we can conclude by saying that hence the cost price of the product is 8.2. Selling price is all the time greater than cost price. So you can see clearly here that the selling price was $10. At the end of the day, the cost price is 8.2, right? If you get it, equal to that or greater than that, you know that your answer is what's wrong. So the most important bit I want you to pick up over here is that anytime we talk about markup, cost price is 100%. Let's move on to the next bit of what? Margin. Let's move on to the next bit of margin. So there's an example in here which I have to talk about. So the cost of a product is $4, and the profit margin, this time around margin, not markup, and the profit margin is 22%. What is the selling price of the product, right? So let's just go through as quickly as possible. So I have the cost price here. The cost price here to be equal to $4, and they have indicated that the margin is 22%. So I have the margin to be 22%. So far as we are talking about margin, I should know that selling price in this regard is equal to 100%. So note when cost price is 100%. Cost price is 100% when we are talking about markup. Right. So if selling price is 100%, given the profit element to be 22%, then we can estimate the cost price percentage to be 100% minus the 22%. And that overall gives me 78%. You can do your calculation over there, but I still think that I'm right. So far as I have the selling price percentage to be 100%, I have the cost price percentage now to be 78%. I can use the if more less analysis to estimate it. So I can estimate the selling price here. The examiner said calculate the selling price. So I can indicate by just saying that if my cost price is $4, so I say that if 78% is equal to $4, right? Then the selling price, which is 100%, will give me what value? This basic what? Business mathematics. So which we need to ensure that we're in good shape. So 100 divided by 78 times my $4, and whatever be the case, my selling price should be greater by my cost price. So you end up getting it to be 5.12. That's it. So be very mindful of the key tricks over here. Markup, cost price is 100%. Margin, selling price is 100%, right? So I move on to the next bit to explain what we mean by target cost gap and how to eliminate target cost gap. But first of all, the use of the target cost, the use of target cost. The advantage of using target costing is for the purpose of decision making. All the costing techniques, we tend to go through that. Why do you want to determine the cost of the product? You want to determine the cost of the product on the basis of what? Decision making, right? Before I proceed with the other bit, let me just see if one of the issues that I want to talk about is actually incorporated in this document. If it is not in here, it is not in here. So let me talk about it as quickly as possible so that at least we can see that we are okay with this bit. This question has already been solved, so I'll share with you the recorded lecture, then you can pick it up from there, right? But let me talk about principles of target costing. Principles of target costing. Let me talk about that bit. So we have the first principle as quality management. Quality. So this sort of way of determining cost per unit of a product incorporates total quality management, where we tend to look at the views of the customer before we produce the product. So if you are actually with Coca-Cola, you do not produce your Coca-Cola, just take it to the market. You first of all have to visit the customers through market survey, ask them what they want, how they want the Coca-Cola product to be. So we actually look at the customer's requirements and look at how best we can meet the customer's requirements. And that boils back to what we call quality management. Next bit, we are going to look at what we call functional management or functional analysis, can put it that way, functional analysis. Because we want to get things right, we want to look at all the functions of the organization. The functions of the organization can be the legal department, can be the production department, can be the sales department, any of the department which turns out to play a role in producing the product. We tend to consider them in our functional analysis, right? So in functional analysis, we tend to place the correct individuals at the correct position. If we need you to get a particular sort of task done, we need to put or just ensure that we are bringing in, we tend to look at the individual who is really skilled. If you have a very good accountant, right? You have two people who you want to pick up as the accountant role, but you know for sure that one is very versed in accounting. Then at the moment, at that point in time, what we have to do is that, right? What we have to do is that we need to look at the individual who is really competent, the right tool for the right job perspective. That's what we have to look at. We need not to pick somebody on the basis of whom you know sort of to actually be in such a position, but technically that is what is existing in my dear country and there's nothing we can do about it. Let's just accept it, that perspective and go. Maybe we'll be the future generation to change that bit, but I do not see any change coming up in future, right? So quality, you can also talk about functional analysis. You can talk about elimination, duplication, or let me just say elimination of duplication or elimination of waste, right? Elimination of waste. So we need to also eliminate what? Waste. We need to also eliminate what? Waste. Then we also look at what you call just-in-time environment. A just-in-time environment. It's an environment where little or no inventory is kept. And that is what we have given the terminology in Ghana as the what sort of where you go to the circle, Accra Central, the circle guys, that is exactly what they are doing. In fact, they are exhibiting that sort of technique unconsciously. They do not want to keep any warehouse because they do not want to incur any cost of warehousing. They are just hovering around. If they see that you are also hovering around, they know for sure that you actually need something to buy. They ask you if you probably need a laptop charger to buy. They'll tell you to just wait for them. They'll just visit a shop, somebody who wants to incur cost of warehousing. But that individual do not want to incur any cost of warehousing. So he just go to the shop where they have that bit, get it, if it, let's say 50 Ghana cedi, now sell it to a 70. Take that 50 Ghana cedi to the owner, then just get a profit of 20 Ghana cedi without incurring any costs. Without incurring any cost. He has been able to get, without incurring any cost, he has been able to get what? Profit without incurring any cost. Without incurring any cost. So that is what we call the just-in-time what? Environment, where little or no inventory is kept. Where little or no inventory is kept, right? So target costing creates a lot of benefits, in decision-making, saving costs, and those big. Now, what if there exists a target cost gap? A target cost gap will exist if the expected cost by producing in-house exceed what the customers are seeing, and that will be a problem. If you are a performance manager, I tell you, sitting in your car, going home, you cannot what? You cannot what? Relax. You cannot what? Relax. You cannot relax. Please just give me a moment to pick up a call shortly, then we proceed. Sorry, guys, for the interruption. It was something which was really needful that I needed to attend to, right? So sorry for that. In fact, sometimes I tend to plan in a way, but you know for sure that in real life situation, sometimes whatever you plan is not what actually materializes. Okay, so let's make a move. So I was talking about possible ways of eliminating the target cost gap. If the target cost gap exists, eliminate it, because we have stated that if you cannot eliminate it, do not even think about producing the product. So possible ways of attempting to eliminate the target cost gap. What are some of the ways? I've given you a detailed ways of eliminating the target cost gap, and please, you can pick it up, right? So one, you need to review the raw material features. So the raw materials that you have, you need to review that. And our quest is to reduce the cost. But please, the raw materials over here, the supplier in which you are getting this material from also sometimes play a role. So is it that you are only buying from one supplier, or you can actually get the product from other suppliers and compare prices to know the one which will give you the quality status and also give you the lower hot cost. So you can review the raw materials. Now listen to it that if we want to eliminate the target cost gap, please, we cannot do anything about the target cost gap, the target cost. This is the side that you have to be very careful. Please, we said that the target cost, which is also called the desired cost, we got it from the external analysis where there's a perfect competitive market. You cannot do anything about the target cost or the cost coming from the external analysis. You cannot tell the market whatever you want to say, please. So if you want to eliminate the target cost gap, then you are to rather look at how you reduce something in the case of the expected cost, which is the in-house. That is the only point or the only side where you have control. And that's the only side you can do an adjustment. You cannot do an adjustment in the market. You cannot tell the perfect competitive market what to do. You only cannot influence what we are to do. That is the sort of issues that you are supposed to note. Right, good. So we are to note that any issues of material, anything about material which we can lead to reducing the cost of material is accepted, is an answer. Anything in the case of labor cost, which you can come out with to reduce labor cost, is an answer. Anything of overhead that you can come out with to reduce the overhead cost is an answer. So technically, we are talking about the in-house costs. Those in-house costs that we came out with, right? In the case of here, we said the direct material cost, direct labor cost, overhead cost. If you can come out with any strategy to reduce any of these elements, it is an answer to eliminating the target cost gap. So the first bit I'm starting with is the issue of what? Review raw material features. You can review that. Probably maybe the earlier one it was really expensive. You can review that to reduce that cost. The second point, we can look at team approach. So we are saying that cost reduction works best when a team approach is adopted, right? So if you go to a place like Coca-Cola, the production of Coke tends to go through processes. Probably the first guy dealt with issues beautifully in a good sense that there wasn't any wastage. But the second, third, it can be just one person, just like running a baton. If one person can just destroy the process. The starters can do perfect job, but if the finisher decide to sleep, at the end of the day, you guys are going to lose. So we need a team approach, a collective effort in reducing what? The target cost gap. We need the next one. Yes, we can explain in any angle. We are not saying that the explanation over here is the only explanation. Please, we are not saying that in the professional world, you can just tell us what you think. We review it. If it's correct, we just give you full mark. That is basically what we consider in marking. We do not, it's not like a case of what a university program where you tend to produce what your lecturer actually brings down, right? That's not academic program. This is not academic program to bring that sort of issues in here. Review the whole supplier's chain. Review the whole supply chain, right? We are saying that each step in the supply chain should be reviewed, possibly with the aid of staff questionnaires to identify areas of likely cost savings. Areas which are identified by staff as being likely cost-saving areas can then be focused on by the team. For example, giving examples are perfect ways of what? Explaining point. So you can go to give examples on the day of exam to tell the examiner they were explaining. For example, the questionnaire might ask, are there more than 5 potential suppliers for the raw materials used in production? Clearly, a yes response to this question will mean that there is a potential for tendering or price competition. That means if there are a lot of suppliers, we can actually get can do that sort of window shopping to actually get raw materials which are at a cheaper price. We can also look at the components to look at how possible we can reduce cost. Is the component too bulky, too complex? Can we use simple processes and procedures? We got production, the design cost, all those bit creating waste. What is the component? Is the component creating inefficiencies that we can improve those inefficiencies by making it efficient? Can we bring in smart and easy designs to still achieve the same purpose? Labor cost. Labor. Are you going to train labor, scale your labor, give them the thorough knowledge and expertise, that sort of to get the thing done? Are you going to give them incentives? Are you going to motivate them? Sometimes the managers of the organization are very bad that they demotivate even the employees. So better management, smoother workforce, and staff incentives could also help here to motivate them. Right. So I've given you some bit, I think 5 points in the ways of eliminating target cost gap. I'm not saying that these are the only point, but so far as you talk about any of the issues in the case of how to reduce material costs, reduce labor costs, reduce overhead costs, oh, you are in good shape, and that is an answer. Now, we tend to have manufacturing industries different from service industries. Manufacturing industries produce what products? So we say manufacturing industries, manufacturing like Unilever, Unilever can talk about, let's just say, can talk about these guys. Let me just, at the moment, Unilever is the only one in my head, right? But I can talk about Nestle, right? So Unilever, can talk about Nestle. All these bits guys are there, having a lot of what wholesalers, retailers, and those bits. So manufacturing produce what product? And services like accounting firms, service industries. And industry is a collection of what? Firms. So service industries like IT firms, accounting firms, we do not produce any product. The financial statement is not our product. We cannot just say there's a product which can be hold, felt, and touched. If it's actually stated online, unless otherwise you print it in hard copy. But whatever we tend to do is what, let me just say, in the service perspective, just like a musician, you cannot go and hold and feel it and touch the music. How can you hold? Is it tangible? Is that music tangible? Students still dance to the tune of Ebony, still dance in the tune of Ebony, see that Ebony is even what alive in that perspective. You cannot actually go, oh, this Ebony song, you actually use your two hands to actually, no, that's not what applicable. It's not really applicable. If you can do that, then you are in a different world. If you can do that, then you are in a different world. So it is important for us to look at the distinction between service industries or service companies and manufacturing companies. Some time back, that is in the case of 2011, 2012, 2013, if you're going to write this paper and you have not prepared for this bit, you're going to find yourself what wanting. But this bit, the examiner do not examine that bit in the current situation, but you still have to look at it because it's still important bit for you to look at. The 5 major characteristics that distinguish service companies from manufacturing companies. So let me just look at it in the case of manufacturing. So let me just come out with the first one, manufacturing. Then the next one, I look at it in the case of service. So manufacturing companies, whatever they produce are what? Tangible. Whatever they produce are tangible. You can hold it, feel it, and touch it. Here, service, intangible. Service is what? Intangible. Then you come to 2. You can what? There's what? Separability. So, separability, right? So you can separate it. Production and consumption can be separated. Separability. Unilever will produce its milk, and it will take 2 months before what? Before Joyce will actually consume that. So it is separable. But in the case of service, production and consumption is actually done at the same time. As I'm teaching, it's a service. So as I'm teaching you, understanding means you're consuming the product. So production and consumption is concurrent. Concurrent means it is simultaneous or concurrent. At the same time. 3, we said that manufacturing, if we're producing biscuit, Piccadilly biscuits, it's still Piccadilly biscuit. Some time back, we used to enjoy Piccadilly biscuit, but for some time now, I do not normally see Piccadilly biscuits. But some time back, we used to enjoy Piccadilly biscuits, right? So we tend to say that products, Piccadilly biscuits is still the same. Somebody actually hinted that if you go to one center in the case of Las Palmas, and that day their food is not like the other day, then you don't even worry yourself to look at the other centers, right? One at La Paz, one at Medina. If you go to La Paz and it's not actually delicious, that is what somebody actually stated, right? A customer in that bed, right? So if you go to La Paz and it's not actually good to you in the way that you want it to be in the case of your requirement, and you decide to come to Medina, it's still going to be the same, right? That sort of. So in the case of product, it turns out to be the same. That Piccadilly type of biscuit, it turns out to be the same type in that bed. So manufacturing, their products turns out to be what? The same. Turns out to be the same, right? Then in the case of services, we say it is heterogeneous. So over here, we say it is homogeneous. Here we use the terminology homogeneous. Homogeneous. So we have homogeneous products. Then over here, we have what? Heterogeneous. 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 The word hetero means what? Different. The way a manner Joyce will sing a song will be different from how probably, let's just say, Catherine will sing a song, right? And the way a manner Henry does his teaching will not be the same way as Steve Willis. Steve Willis will still do those bits, but Steve will still say that we have a lot of things in common. We still have a lot of things in common. And the next one, we can talk about perishability. Perishability. Every product, even car perishes. Building perishes because there's going to be existence of what? Depreciation. There's going to be existence of depreciation, right? But services do not depreciate, right? So not perishable, not perishable. Students still listen to Ebony's song and still dance as if that Ebony is not dead. Students still listen to Michael Jackson's song in the case of Speechless and still dance to it as if Michael Jackson never died in 2009. So we say that it doesn't what? Perish. It doesn't perish. Doesn't what? Perish. Doesn't perish. Right. So we can also talk about the next bit. Manufacturing companies, their end product can be transferred. Can be transferred. Somebody can buy a house and sell that house to another person. So transfer is possible. Transfer is possible, right? But here, you cannot actually what? Transfer, right? If students sometime back, some quality tuition providers tend to listen to you in the case of exam tips and also train their students in that light. But if it's a recorded lecture, this current situation, if a student tend to listen to know that this is Henry speaking, that is that talkative. No. It's that talkative. It is that talkative. So service companies, not transferred. Ownership cannot be transferred. Not transferable. Not transferable. It still becomes my property. That's enough. Good. So we have a beautiful question here in the case of, that is Edward Cole. You can check that in your exam kit. But I just changed the name and replaced it with UPR Limited. I just changed the name and I replaced it with UPR Limited. Because there's a recorded lecture to this effect, I will not solve this question. I'll share the recorded lecture with you. Then at least you can go through to keep yourself satisfied. But let me take this opportunity. To talk about something small. Then at least we will just call the meeting for today. But if you call the meeting for today, it does not mean that you are also satisfied until you listen to this recorded lecture again, and then you also go through the other recorded lecture, which the solution to this question is actually indicated in there. Doing that is what is going to make you in good shape, right? Doing that is what is going to make you in good shape. Now, before I even conclude with that bit, let me just verify that in the case of my resources in there and ensure that I still have that so that I will not conclude. I will not conclude in a way which is actually going to worry. So just give me a moment. Let me sort myself out with that so that at least I know for sure that we are moving. There's a limitation of the online class. the only limitation, right? The only limitation so far, which we tend to talk about, is that if the student is not really following and also putting him or herself in good shape with exactly what you are looking at, then the student will not appreciate this bit, right? Now, current situations, we are not in those times where the tutor will be putting pressure on students, right? Putting pressure on students, do this, do that, those bit, those sort of setting are no more. Those sort of setting are no more. I think that, yeah, this question has been solved in this recorded lecture. And I think that you can go through. The solution is still in there. If you go through the recorded lecture and you are not satisfied, please, you should call me for the clarification. But because we have the solution in one recorded lecture, there's no need for me to really waste time with this bit. But the only bit I'm going to talk about, then I'll bring the session for today, is high or low method, because this question is going to expose you to high or low method. So I need to walk you through. But somebody just said that, Henry, but this is not going to take you much time to do this, but I need to actually ensure that I'm doing a good job, right? So it is not complicated. You can just go through and keep yourself satisfied, right? The only thing is that we will need high or low method. So let me explain that side where we need the high or low method application. Then at least I think that you're going to be fine. Now, high or low method is a technique we use to separate. So you have to indicate that high or low method, right? We use this to separate. So use to separate fixed cost, use to separate fixed cost, and variable cost, use to separate fixed cost and variable cost from total cost. So if you have total cost, if you want to split the total cost into variable and fixed, the technique we use to do that is what we call the high or low method. So you know for sure total cost is equal to total fixed cost plus total variable cost. So if you want to split or know the portion of fixed cost in total cost, if you want to know the portion of variable cost in total cost, look at what? High or low method. So per this, the examiner has given us the total overhead. Total overhead, that means a portion is fixed, a portion is variable. Now, so here we have the total overhead, production overhead. Production overhead means fixed and variable. We have it to be entirely $620,000, right? It is in dollars, monetary value. So $620,000. Then we have man 2 to be $700,000, right? Then the 620,000, its basis of absorption is assembly what? Because overhead, we can use either absorption cost or activity-based cost. But here, what is applicable is absorption costing. So the basis of absorption is what? Assembly labor hours. So I need to use the principle of high or low method. High or low method, first of all, helps you to calculate variable cost per unit. In applying high or low method, it first of all helps us to calculate variable cost per unit. But here, because it's overhead, it will help us calculate the variable overhead per unit. That is going to be the first thing to calculate. So how do you calculate that? We tend to look at the principles over here. It is all the time the highest value. So here we have the highest value to be 700,000 minus 620,000. So 620,000. Then we divide this by, so the 700,000 corresponding unit was 23,000. So we divide this by 23,000 minus 19,000. So at the end of the day, when you go through this calculation, you end up getting what? $20. You end up getting $20 overhead per unit. Now, because we have the $20, the overhead per unit, we do not have the fixed overhead. So we need to estimate the fixed overhead. But because you have the total overhead, we should know that total overhead. So next line. So total production overhead production overhead. Production overhead comprises of total variable production overhead plus total fixed production overhead, right? So we can pick either the 700,000. So this is total, right? We can pick one of them. So you can pick this, this bit, the 700,000 is total production overhead, comprised of fixed and variable. 620 is also total, comprised of fixed and variable. We can pick any of them. You still get the same answer, right? You can test that wherever you are, you get the same answer. So I can pick the first one. I can pick 620. Somebody can pick 700,000. Any of them works, you get the same answer. So the total overhead is 620,000. And because we have gotten the variable overhead per unit to be $20, if we know the number of units, we can multiply to get the total what? Variable overhead. Variable overhead, right? So I'll just say 20 times, what is the total units? In the case of 620, the corresponding base of absorption was 19,000. So I'll say 19,000 hours. Plus total fixed overhead. Total fixed overhead. So total fixed overhead, I don't know that, but I can calculate it, right? So what is, so I still have my 620, I'm doing it bit by bit for you to understand. $620, right, is equal to what is $20 times 19,000? That gives us what? $380,000. So plus total, let me just shortcut it, total fixed dot O/H. Overhead is O/H for short. So I'll just say my total fixed production overhead is equal to what? Is equal to the $620,000, $620,000 minus $380,000, and that gives me what? $240,000. $240,000. So every month, for the entire 12 months, every month, the fixed production overhead is $240,000. But now that we have used the high or low method to get the variable overhead cost, for the fixed overhead, we cannot use any method in estimating the fixed overhead apart from either absorption costing or activity-based costing. So let me move on to the next one. Let me change color a little bit. Let me change the color a little bit. So for the variable overhead, the high or low method will fish it out quickly. But the fixed overhead, you use either ABC or AC. I think that you already have those absorption costs in those bits. But because this was just monthly, if you want to calculate that, we said OAR, we have to calculate OAR. OAR is the total. This 240,000 just for 1 month. So if you need the total for the entire 12 months, you multiply by 12. That will give you the total fixed production overhead, right? Then you divide it by the total basis of absorption. The total base of absorption over here, what is the total base of absorption? So the examiner indicated that in a typical year, so you see the base of absorption is yearly. So we cannot use that 1 month fixed overhead. So in a typical year, 240,000 assembly hours will be worked by UPI. Good. So that is the basis. So the numerator, which is the total production overhead, is a yearly figure. The basis of absorption is also a yearly figure, and we are in good shape to just estimate that. So that is 240,000. So do not think that the 240,000 are the same values. They're different. One is a basis of absorption. One is the fixed overhead per what? Per month. So at the end of the day, we still get an answer to be what? 12. We still get an answer to be $12, right? So that ends it. That is the only bit that I would want you to be alert. And I think that I'll still share with you the recorded lecture. You can pick it up from there. So in about 5 minutes, I need to bring my session to an end. Look at how this computation was done, component 1, how we got that. That explanation, you can get it from that bit. Next one, component 2, how we actually got that, right? Other material 8.1 was given. Assembly hours is based on the number of hours worked. And do not forget that there was a principle of idle time. So you can see that 100 over 90. They work for 30 minutes, so we convert it to an hour by divided by 60. You multiply by the rate per hour, which is 12.6. And because there was an idle time of 10%, 100 over 90. This bit, the variable production overhead, is still based on the number of hours you worked, and they worked for 30 minutes. So 30 minutes, that is 30 over 60 times 20 will give you 10, and 30 over 60 times 12. Do not forget that in applying the principle of absorption cost, you've got $12. And because labor work for just 30 minutes, you cannot just capture the entire $12. So 30 over 60 times 12. At the end of the day, we end up getting our total costs, expected cost in-house to be 35.92. Meanwhile, customers want the product to cost 35.2. So there is a problem. Performance manager, you cannot sleep. If you're not able to eliminate this target cost gap, you cannot sleep. So there's a target cost gap of 0.728, and the examiner asked you to talk about possible ways of eliminating that target cost gap. Ladies and gentlemen, I think that I'm waiting for questions. If there's none, then permit me to bring my session with you in the case of target costing to an end. And so far as we have gone through it in the case of the knowledge base. The only thing which turns out to be in existence I need to eliminate for you to have 100% coverage in the case of target costing is by walking you through learning curve theory. But that will be looked at later on. So if there's no question or questions, then permit me to bring my section to an end. It is still your tutor, Henry Breman, and you can call or WhatsApp by 0243 583352. 0243 583352. You can call or WhatsApp 0243 583352. Students, in the case of the global perspective, so just come out with +233 243 583352. Or you can, for short, email me via bremanhenry1@gmail.com. You can just link up. I'm more than ready to assist you with any other hot inquiry. Just bring on board your questions in the case of ACC PM, and I'm more than ready to assist you. If there's no question, permit me to bring my session for today to an end. It appears there's no question coming from students. Please, the section has started for December perspective, and we still need more students to get more cash into our pocket. It's very, very important, right? In that effect, so you can still talk to friends and let's see how best things will be. Have a very good evening and bye-bye.